Everyone, and welcome back to the second edition of the world's largest FinTech Fest, Global FinTech Fest, organized by Payments Council of India and FinTech Convergence Council, the two councils of Internet and Mobile Association of India, along with National Payments Corporation of India. This fest is presented by the Ministry of Electronics and Information Technology, Government of India, Reserve Bank of India, and is supported by NITI Aayog, Startup India, and Invest India. With that, I would also like to quickly thank our other partners, our investments partner, Venture Catalyst, our agenda partner, PayPoint India, our silver partners, Dubai International Financial Center, Jakarta, CRIF, and our bronze partners, Swiss Business Hub India, Vienna Network, and Ubro Capital. The second edition of the Global FinTech Fest revolves around the theme FinTech Empowering a Global Digital Economy and is providing with an in-depth understanding of the latest businesses, policies, investments, and technology developments within the FinTech landscape globally. With that, it is my pleasure to introduce to you this very special session, a fireside chat on the topic FinTech Investments, a Winning Strategy. This session is specifically presented to you by Open Financial Technologies, and it is my pleasure to introduce to you our esteemed panelists, Mr. Tilman Erbig, Managing Partner of Flourish Ventures. We welcome you, Tilman, along with our esteemed moderator, Ms. Dina Jacob, CFO and Co-Founder Financial Technologies. We welcome you, Dina. And just a side note for all the audiences, you may put in your questions on the right-hand side in the chat box Q&A session, and we will try to respond to them at the end of the session. Over to you, Ms. Dina.
Thank you, Garima. And Tilman, delighted to have you here today for this session, and good evening to each one of you who's here to listen to our discussion today. Thank you for joining in. Tilman, it has been a very intriguing journey that you had till date, starting your journey as a journalist and then a PhD in economics, a stint with IMF, and work taking you from a partner at McKinsey, where you built the global financial services and healthcare practices, and then to leading financial inclusion at CGAP. Incredible, and you have covered a wide spectrum of markets and experiences. It would be interesting to understand from you how this entire journey shaped your views as a fintech investor.
Well, thank you, Dina, for that very kind introduction. More than anything, I guess it shows that I have been around for a while. As an investor, it probably started some 10 years ago. You know, we were looking, in particular in emerging markets, we were looking at what could we do to include more people in the formal financial system. More than half of working age adults were excluded totally. No single touch point with the formal financial system. And microcredit had proven the point that the economically active poor families in the informal economy both need financial services and demand them, and that they can be served profitably. But it was hard to scale. So we realized the traditional cash-based brick-and-mortar approaches to retail financial services just would not work and were not good enough. And at the same time, the mobile phone was starting to rise its victory march. The 2G feature phone, you remember those little flip phones? And so we felt, wow, something is happening here that could be leveraged to reach far more people with far better and adequate and far cheaper financial services. So we started investing in that context. It was before the term FinTech was even coined, and we have never looked back ever since. 4 or 5 years ago, of course, or even a little longer, what then happened was that the world switched to smartphones. And out of a sudden, a whole new range of approaches was feasible, riding on the infrastructure and the open architecture type infrastructure that the smartphone technology and environment enables. And so we saw a flurry of investments, still typically investing in or digitizing traditional financial services, right? Lending, asset management, robo-advisors, insurtechs. And these things are still very important. These are the startups, right, from 6, 7, 8 years ago that now are going public. But we have still seen another evolution, if you will, accelerated by the pandemic. And that falls under the header of embedded finance, which I'm happy to talk about.
Oh, that brings to mind. That's a very interesting transition we have seen from the feature phone time, from the physical part of the entire financial system running on the physical part of it, and then transition slowly to the digital part, which again was, started and in fact accelerated by the smartphone penetration, the internet, all the infrastructure. And it's very interesting point you have touched upon, which brings me to the next part of it. Last couple of years, and even during the pandemic, we have seen a lot of things accelerating and changing in the entire fintech space, and particularly when it comes to digitization. So this is where you have touched upon one of the themes, but wanted to take your inputs on what is a theme that is close to your heart right now, and what is a key trend that you would put your bet on right now?
Yeah, I hinted at that. It sort of falls under the header of embedded finance. And this started before the pandemic, but it really got accelerated because out of a sudden, the entire world had to figure out how to live, work, consume, socialize from remotely, from home or other safe places. So this notion of embedded finance in this world has three components to us. The first one is non-financial platforms that are actually super important and helpful in people's lives because they help with making a living, they help with procuring goods and services, they help with entertainment. So be it for gig economy workers, small corner shops in the informal economy, smallholder farmers, all of them are interacting with platforms much, much more than they used to. And these platforms, because they are helpful, they have high engagement, low customer acquisition cost, and they generate proprietary data, insights that allow for a type of credit or insurance underwriting that was previously just not feasible. So embedded finance has these new platforms. It then needs product plugins when it comes to insurance or credit. The non-financial platforms don't want to do that themselves, or they can't do it themselves. So they need the insurance or the credit specialists. Buy now, pay later would be the most prominent example right now of an embedded product. And then, of course, this new industry structure with non-traditional platforms, plug-in products, they still need to connect to regulated balance sheets and capital markets. So we have also seen the twin explosion of investments into an API-based modern fintech infrastructure. So all these pieces have accelerated, they make a lot of sense, and we have invested across the board, across geographies, in non-traditional platforms. In India, we invested recently in Aqua Connect for shrimp farmers, Apna Club, small businesses. We have invested, or we are an investor in product plugins, Zest most prominently. In India, we were the first institutional investor there, very proud of that. And we have invested in B2B fintech infrastructure, YAP, which is really doing very, very well in India. And we have done the same across markets, including in the US. So we are one of the few investors who actually invest in the US and in emerging markets, which gives us pretty unique insights.
So, gentlemen, that gives in. So, while you talk about the embedded finance and the recent trends which are coming in, it also means that it is moving away from in the financial part remaining in silos and getting, blended with the workflows or blended with the transaction, where the transaction happens, which is emerging as a theme and which is getting in different forms right now. That being said, and since you rightly mentioned about the variety or rather different geographies you are in, and this amazes me that you were able to successfully look at and build a portfolio equally in a mature market as well as in emerging markets. When you talk about emerging markets, right from MENA to Bangladesh to India, to talk about it, and you have across regions. And this brings me to I mean, it makes me wonder, how did you navigate, especially when it is in this digital? There are two challenges which we have generally seen. One is on the infrastructure, especially from the coming from the regulatory side, and regulation also becoming some sort of bottleneck, or I would say that in terms of, because this was designed specifically for the physical part of it, and the transition hasn't completely happened. Yet, this is going at a very high accelerated pace at this point in time, in the sense the evolution in the digital part of it. So, how did you see the regulation playing out in various of these regions? And have you seen any kind of common theme you could see in terms of the changes that's coming in? And how much the regulation should be flexible?
Yeah, that's a super important question, Dina. So I'm probably not so much seeing common trends, but a few lessons I'm happy to share. You know, whenever technology allows for very different either product innovation or, more importantly, frankly, business model innovation, that technology change tends to hit a system, a financial system, at a certain point in time. And that point in time is characterized by the legacy infrastructure, by the regulatory setup, by consumer preferences at that point in time, and by the incumbent industry structure, frankly. And you have to take all these type of things into account. And some help you and some hurt you. So the US, where we invest, which is obviously the most advanced economy, it has pretty ingrained behaviors. It has a very strong incumbent industry structure. It has a legacy infrastructure, which is holding us back. It has a very fragmented regulatory system. So FinTech is actually at some level more difficult in the US, believe it or not. At the other end of the spectrum, from our perspective, geography we are quite excited about more recently is Southeast Asia. It has higher per capita GDP than India, for example. It has a higher mobile phone penetration than other emerging markets. Yet, financially, the financial system is pretty underdeveloped. So these notions of embedded finance, non-traditional platforms being the natural owner of a lot of retail finance is probably stronger in a market that is characterized the way I just described it for Southeast Asia. India is a very interesting place because on one hand, of course, it is per capita income-wise, it is still behind the rest of the world. There's huge needs there in India. On the other hand, India has a very sophisticated financial system, capital markets, and India made, as you all know much better than I, made this series of investments in a digital public infrastructure, the stack, that really allowed for rapid innovation. So India is a unique market and a very big market, and that's why we invested so early in India across a series of innovations in the first wave of FinTech that I described to you earlier, and we are very active in this new second wave of FinTech. So India is a super exciting market. All of them are very much characterized by these combination of factors.
Awesome. That's really, good to see that across regions there is a push in the regulation, and in terms of comparison of the markets, emerging markets, some of them are much more forward from a financial ecosystem as well as from the stack that they have built. But at the same time, also would like to understand, because when you talk about when it comes to the embedded finance, how much of a democratization till the time it becomes a very popular amongst all of you who has to build, or rather, as a concept, it still is very concentrated with a few companies. It's not so democratized, and while it is emerging as a probably an investment theme, and or rather when it is coming as a few companies solving for it, in terms of democratization, that's not happening across, right? So what are the other formats which are coming in terms of aiding the digitization?
Yeah, so there's no doubt in my mind that we do need, and that's been true for the last 15, 20 years that I have been doing this. We do need tech-led innovation to reach more people, lower costs, for the system, produce better outcomes. So I'm unabashedly pro tech-led innovation, productivity increases. Otherwise, our cost structure is just too high to serve people. So
Right.
tech is good. And the best tech or the best innovation that leverages technology in the financial services is the innovation that, frankly, makes things so much better that everybody benefits from that. And we have seen this. So mobile money, which famously started in East Africa, in Kenya, M-Pesa, started with urban dwellers who send money home, but now it's used by everybody, rich and poor, because it is such phenomenally better a value proposition. So tech has enormous promise there. And of course, tech has downsides as well that we need to be aware of, right? Tech-led business models lead to winner takes all dynamics. So from a regulatory perspective, out of a sudden you have to, as a financial regulator, you have to worry about competition policy. That was not a concern historically. Tech can lead to new exclusions, algorithmic biases. We might not even know, right? You apply for credit, you get denied. You don't know why. In this country, we are very sensitive about that. So you need to have a policy framework and a regulatory framework that understands the upside of tech-led innovation to promote inclusion, reach more people, to develop the financial sector, and that also recognizes the new risks and manages those. Privacy, data control, I mentioned already the winner-takes-all dynamics of tech-led business models. So it's a balancing act, and I have a lot of sympathy for regulators. They need to balance these objectives of financial stability, inclusion, promoting the underlying economy. At the end of the day, financial services are a means to an end. And we live in a fiat financial system, so people need to believe in it. They need to trust the system, and we don't want it to be used for nefarious purposes. So regulators, policymakers have to strike this balance between harnessing the upside and managing the new downside risks. And the best way to do that is in dialogue, in engagement, in learning from each other. Nobody knows exactly where this journey could be leading, but there is great potential, which is why I have been so excited and so active for the last, you counted them at the beginning, 15, 20 years in this space.
That's amazing, Tillman. That actually opens up another aspect of, in terms of regulation being digitally native, if we were to look at it that way. Which are other areas or regions you have really admired and looked up to in terms of opening up the regulation, and what are the right things in the right direction which could propel the ways in which one can look up to and say that this is something which, if we go towards or take this path, it is going to lead us somewhere in the near future to a conclusive way in which we can make this transition much more effective and fast.
You know,
A
the
framework
regulatory.
that you are, yeah.
Yeah, so in the global context, the regulatory environments that might have a little bit of an easier time are the ones that are forward-leaning, that operate in open economies, and that have a relatively simple regulatory setup, right? 1, 2 regulators, maybe a prudential regulator, maybe a market conduct regulator. So in that context, the UK is pretty forward-leaning. The UK regulatory setup, the Singaporean setup, the Monetary Authority of Singapore is pretty forward-leaning. The Indian setup has done a number of good things. The US is difficult because we have, depending on how you count, at least 5 federal regulators, and we have a lot of activity that's actually regulated at the state level. I think the common thread is, I come back, and this might sound a bit unsatisfactorily high level, but I think the common thread must be this notion of engagement and learning together. I give you an example of something we did in the US. We couldn't we were incapable here of setting up a sandbox type environment, right, where innovators can experiment under regulatory forbearance. It's just the regulatory setup here is too complicated. So what we instead did, we sponsored with others out of our foundation. We have a foundation arm that can make grants in the public interest. And we sponsored an entity called the FinReg Lab, which is basically an industry sandbox that engages regulators. And one of the first things they did was they worked with 5 lenders, 3 or maybe it was even 6, 4 on the consumer side, 2 on the small business side, that use alternative data sources for lending. Pretty big topic. Right. And the concern in the US is that you use these alternative data sources and that they might lead to discrimination that we are not comfortable with along racial or gender lines. And so what the work showed, though, that the use of alternative data sources expands access without having a disparate impact, which is the regulatory term for discrimination. And that was an important finding, and it has informed policymaking in Congress. So it's just one example. There's tech sprints happening all around the world where regulators are saying, you know what, we need different approaches. Take anti-money laundering, for example. We know that our financial system spends tens of billions of dollars trying to track suspicious activities. We estimate that we might catch 1% of that bad behavior, because the bad guys are digital, real time, fast, right? And the regulatory setup is analog, batch based, looks at quarterly data. We need to catch up. And so there's a real regulatory awareness around these type of things. And there have been tech sprints. Global regulators have worked together to hack. They don't like the term. So we didn't call it hackathon because they don't like the term. But there was a tech sprint where teams from incumbent industry, tech providers, financial regulatory agencies all work together to find new ways of improving, in particular, in the case of anti-money laundering, this notion of suspicious activity reporting. So stuff is happening. It's all very encouraging.
That's amazing. So when you look at how things are evolving, right, from the regulator and the regulated entities, which is traditionally the banks, which used to be the gatekeepers of the trust and the money movement and who is doing what kind of transactions, everything. And now we have this additional layer of people who understand when the digitization era, we have the fintechs who is also leading it in terms of taking it to the market. So it has emerged as a ecosystem, which is the fundamental part of, be it embedded finance, be it, the challenger banks and the neobanks, which are coming up in terms of taking digital and democratizing that. So that's an interesting way in which the ecosystem is coming towards handling the new age challenges and new age requirement, as you rightly mentioned, accelerated by pandemic, though it was there previous. In our experience also, we have found the same, because pandemic literally accelerated, or rather it was a trigger for making it a point that this is a necessity for you to shift to digital, both from business side and from, we have seen from the consumer side as well. And that has become a trigger. So that being said, what's your view on this partnership, and would it be a conflicting thing, or how it is going to emerge as a blended? For now, this is working as an ecosystem in various stages right now. But in the long run, and when you're looking at the investments and looking at the regulation which is evolving, the traditional banks, again, who are working very closely with the regulator, license holders, and then the collaboration which is taking it to the ecosystem, how this entire landscape, how do you see this landscape evolving from here?
Financial services have always been an ecosystem, right? I'd argue. And financial intermediation, right, to use tech parlance, tech language, financial intermediation is a two-sided marketplace, right? So for anybody who wants to take a loan, you need a saver somewhere else who is foregoing current consumption power and says, well, I want to save for old age. I'm not spending all my money. I put it into the system and the system puts it to good use. Same is true in insurance. For anybody who assumes risk right? Or wants to lay off risk. You as a consumer, you don't want to bear the risk of fire in your house. So you're paying somebody to assume that risk for you. So it's the ultimate two-sided marketplace. It has always been around matching the needs of borrowers versus savers, risk layoff versus risk taking. So that's actually not new. And so what the way I think about it is that you want a systems design, a financial systems design that is robust and it's optimized towards reaching, as I said earlier, as many people with the best possible services at the lowest possible cost. And you could call that democratization. I use a little bit sort of the nerdy financial systems deepening language. And how do you do that? I think you have to have guiding principles, right? And we wrote those down, and there are 5 of them. And we are saying the first principle is, listen, finance has to help real people in the real economy. Otherwise, it sort of misses the point. It's a means to an end. It's not an end in of itself. Secondly, business models, revenue models of financial providers need to be aligned. The incentives in these models need to be aligned with the financial well-being of the customer, right? If you make money as a provider by taking advantage of your customer, that's not good. We don't like that, and it's not a winning proposition in the long run. Thirdly, we believe this is important in today's environment, or in the age that we are living, that people ought to have control over their data. They should have agency over their data. They should be able to share it with whom they want and have it protected to be shared from people with whom they wouldn't want to share. And then we need this notion of an open API-based digital infrastructure that everybody can ride on. And it needs to level the playing field. And by the way, India has really made a lot of strides in that regard. The private sector should compete at the application layer with better value propositions. It shouldn't replicate an infrastructure that is utility in character. And then, of course, all of this needs to be regulated. We talked about that already. By trying to balance these objectives of stability and inclusion with the objectives of consumer protection, etc. So you should have a system design that allows for all of these fruitful cooperations to happen as they have always happened in the financial sector.
Thank you, Tilman. I can't agree with you more on that, and it is a very encouraging sign wherein the entire ecosystem, which has been traditionally handling different functions and how it is coming together in terms of aiding the progressive journey forward in terms of digitization. So now, we are almost at the fag end of our time, but a couple of things from the audience. We have a very interesting question as well. In the light of undeterred and accelerated unbundling of financial products, user attention is fragmented across many options. As an investor, how you evaluate and compare user engagement and stickiness for different ideas? It's wearing the investor hat. Thought, it's a very interesting question.
I first say that we absolutely have seen an unbundling, and that was sort of in the time frame 5-6 years ago that I talked about earlier, where folks focused on one vertical, in particular on the consumer side, one vertical, and tried to do that really, really well. But they also often realize, wow, economically that might not make sense, right? You need to do more. You need to some degree rebundle, and we are seeing that as well. My sense is that indeed consumers, all the sort of behavioral research would suggest that consumers are not going to interact with 20 financial providers, but they might interact with 3-4. We as human beings, we like this notion of mental accounting. We like to keep separate maybe our business accounts with, even in our personal lives, we like to separate. There's a jar, literally a mental jar with a little bit of savings for the small pleasures of life. And we are not going to touch the cookie jar with the money for our children's education for that purpose. So people will will interact with I would think, right, will continue to interact with 3-4 financial providers, and they will do it according to who does best for them in the situation that they are seeking. And we will pay more attention to big decisions like a mortgage for the house, as opposed to, right, our day-to-day payment flow. So it's a balancing act. I think there are limits of what consumers are willing to bear, and so you have to be very, very attuned to that. But I also don't think that we will, as consumers, collapse all our financial activity into one app and one place only. Hope that sort of starts addressing the question.
Right. So to summarize, so bundling and unbundling will coexist, and it is more towards what kind of bundles are coming up in terms of, addressing the consumer need at that point, and then what has to be completely separately, or rather in-depth handle, which is like a vertical relevance. So that's the probably a mental model to look at.
That's thanks, Dina. That was a better answer to the question than I gave. And it's sort of, so an unbundling definitely has happened. There's a rebundling happening often because economically, actually, it has to happen. And there's a new rebundling possible, and it has a lot to do with the underlying needs. And the needs are different for a gig economy worker who's cobbling together different sources of income, etc., from a small business, the corner store. So the needs are very, very different. And by the way, I think people will mostly engage. This goes all the way back to the non-traditional platforms who could own a big chunk of this. People will engage most with whoever is most helpful to them in what they need to do in their daily lives, which is different for the smallholder farmer, which is different for the gig economy worker. It's different for the retiree in the suburbs, right? So there's an incredible opportunity to tailor much better what people need. And then you capture your attention, and then your economics will work, because you have this virtuous cycle of engagement, low customer acquisition costs, proprietary data insights that allow you to tailor the services even better.
Amazing, Tillman. We'll close with one last question, which I want to hear from you. What, in your opinion, is going to shape up the next 5 years of FinTech main trend, and what's going to drive it?
Yeah, I think I do think we are at the brink of really, really interesting changes in financial infrastructure. And that's driven by crypto, and in particular the blockchain technology. I was not a big fan of Bitcoin for the purposes of financial inclusion, etc. Right? Bitcoin was just too slow. The transaction costs are actually quite high. The asset price volatility means the only people who can afford exposure are the people who are very, very much included already. So Bitcoin per se did not excite me professionally. I personally invested in a little bit just to make sure I learn. And then, of course, Bitcoin has the energy consumption, etc., because it relies on this proof of work consensus mechanism, right, which is very energy intensive. But we are seeing evolution now, right? There's proof of stake, there are time arrow concepts. And so you for the first time now have blockchain ecosystems that can transact fast and cheaply. And they allow for very, very interesting notions, this idea of programmable money, decentralized finance, intermediation without a traditional intermediary. Very, very fascinating things could happen over the next 5-10 years. It will exceed all our imagination right now. There's lots of use cases. There's some use cases I'm less excited about for now because they seem self-referential. Margin lending of crypto to buy more other crypto tokens. That, again, is for the digerati and in the included. I'm professionally less excited about. The idea of programmable money, imagine your conditional cash transfers, your government conditional cash transfers. And India has made great progress on that one as well. Imagine you can program that money. The relief checks during the pandemic, Imagine they were time-bound, 3 months only. You could use them for food and rent, but not for speculative purposes or whatever. That's very powerful. The notion of self-executing insurance contracts parametrically, if-when statement is embedded in the transaction, the original transaction. Nobody has to look at that. It's just automatically executed if the trigger event is being hit. Very, very powerful applications. So I'm sure the conference has lots of sessions on that with people who are much more knowledgeable than I am. I watch that space, and I want to make a contribution in that space in the years to come.
Awesome, Tilman. It was a delight having you on this discussion. To summarize, I loved what you have mentioned about financial services is a means to an end, and it has to be real in real life, and nothing like that stands at any point in time. And then bringing in the new trends of embedded finance and looking forward looking in terms of the new technologies. If we thought disruption has come in the system and it is at a very fast pace, good to hear from you that we have to really catch up and run fast and harder going forward. And thanks a lot, and thank you to each of the viewers as well. Thank you.
Thank you, Dina.
Thank you so much, Dina, and thank you, Tilman, for that really insightful session. It totally demystifies this topic, and it was lovely to have both of you. So thank you once again. And thank you to the audience as well for making this session so interactive by posting in your questions. For the delegates, here's your chance to become a proud owner of RuPay on the go. Please do visit the NPCI booth that we have on this platform to apply for your complimentary RuPay on the go device. And you can drop in to check out some details on the NPCI booth. Thank you again to the panelists, and stay safe. And we will be back with yet another exciting session tomorrow. Thank you.
Thank you.
Bye-bye.
Bye-bye.